Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Starbucks Corporation, ticker symbol SBUX, SBUX. We're making a revised analysis of Starbucks today as a popular subscriber request. So currently Starbucks is trading for $107.09 per share, and over the last year, their stock price is up 10%, which is in sharp contrast to the S&P 500, which is down over this period. Beginning in April, Starbucks will soon have a new CEO in Laxman Narasimhan, who will be taking over for interim CEO and Starbucks founder Howard Schultz. The business will have some transition in its management. Over the last 5 years, Starbucks is compounding at a rate of 14% annually. Over 10 years, they're compounding at a rate of about 14.5% annually. And going back prior to the global financial crisis, over the last nearly 2 decades, Starbucks is compounding at a rate of just under 11% annually in their share price. Starbucks also pays out dividends, and their average dividend yield throughout this time frame would be in addition to this compounded annual return. Currently, Starbucks has a 1.9% dividend yield, which is slightly better than that of the yield of an S&P 500 ETF. So Starbucks right now is $3 below their 52-week high. They're up about $40 from their 52-week low. Starbucks is a very large business. They have a $123 billion market cap. So for additional background about the company, Starbucks is one of the most widely recognized restaurant brands in the world, operating nearly 36,000 stores across more than 80 countries as of the end of fiscal 2022. The firm operates in 3 segments: North America, international markets, and channel development, which includes grocery store and ready-to-drink beverages. The coffee chain generates revenue from the company-operated stores, royalties, sales of equipment and products to licensed partners, ready-to-drink beverages, packaged coffee sales, and single-serve products. As of October of 2022, the company operated more than 17,000 company-operated and licensed stores in North America and 18,000 company-operated and licensed stores internationally. Starbucks Corporation was founded in 1971 and is based in Seattle, Washington. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Starbucks based off of their business fundamentals. We want to analyze the business today to understand what are we missing and what could the market have possibly discovered about the business this past year that's led to this kind of outperformance relative to the other members of the S&P 500. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that the average publicly listed business earns about a 7% return on capital, and the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. So by asking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Starbucks in most of these years has earned significantly above average returns on capital, although the company's returns on capital did drop dramatically in 2020. Since then, the business's returns on capital have rebounded, and averaged out over the last 5 fiscal years, Starbucks is earning about 35% returns on capital in a given year. So this is a massive check here on metric number 1, as that's 2.5 times better than that metric we're looking for, and 5 times better than the returns of a typical business. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. So over this time, Starbucks has grown their revenues moderately by about 33%. Their earnings, however, are down by about 25%, and a lot of this comes from a greater amount of interest expense to the business, as the business has added on quite a bit of debt in their recent years, especially as they've been fueling some financial engineering in the business in terms of returns to shareholders, and then also still while promoting expansive growth internationally. Finally, and probably the most important, is that Starbucks free cash flows have declined by about 80% over this time frame when we include their last 12 months worth of numbers. This was because of a $1.5 billion change in their other net operating assets and a $500 million change in their inventories. Those were 2 very massive charges against their free cash flow, so if you're potentially interested in the business, you want to dig in and learn more about those to understand the business in more depth. Either way though, with their earnings and their free cash flows being down over this time frame, this is going to be an X here on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Starbucks on a per share basis. So we're looking for earnings per share growth over the last 5 years. So we learned in our previous metric that Starbucks' earnings were down by about 25% over this time frame. However, earnings are just the numerator in this earnings per share equation. So we still want to take a look at what the company has done in terms of their shares outstanding. Again, because of some of the financial engineering that the business has done and some of their previous goals in terms of their returns to shareholders, the company has repurchased 17% of their shares outstanding in the last 5 years alone. That could be potentially a very good thing for shareholders, especially because of the very high returns on capital that Starbucks is able to earn as a business, and because of the nature of their business. With all of the qualitative factors that go into Starbucks as a business, it's likely that this is going to be an enduring business for a long while to come into the future, even if the business may have stretched itself on some of these return goals, as the company has bought back about a fifth of their shares outstanding over the last 5 years. And so this is important because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. So when a business buys back its shares by decreasing the amount that they have outstanding, they're increasing your ownership percentage in the business, which ultimately increases the percentage of the business's profits that you're entitled to without you spending a dime. So it's almost as if the company is making a partial acquisition of itself. So just like with any other acquisition, we want the company to be getting more value than the price that they're paying. So in practical terms, this means we want businesses to buy back their shares when they're trading for well below their intrinsic value, and it looks like an attractive use of their capital relative to some of their other business opportunities. Even with these massive share buybacks, however, because Starbucks is paying so much more with their interest expense and their earnings have been down over this period, their decline in their earnings are actually outpacing their increase in their share buybacks. So even with those share buybacks, this is still going to be an X here on metric number 3. Next up, for metric number 4, we're looking for something similar. So here we're looking for free cash flow per share growth over the last 5 years. This is a similar story here to their earnings per share. Even with their strong share buybacks, their declines in their free cash flow have outpaced their share buybacks. And so this is another X here on metric number 4. So far, to recap where we stand, through our first 4 metrics, we have 1 check and 3 X's for Starbucks. Next up, for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. We want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over the last 5 years. Starbucks has added on quite a bit to their net debt over this time frame. Currently, the business has about $20.5 billion worth of net debt. And when we add up all of their free cash flows over their last 5 fiscal years, Starbucks has produced $20.4 billion worth of free cash flow. So this is just about $100 million off relative to what their net debt position is. But unfortunately, this is coming in below that debt position, so this is an X here on metric number 5, as it looks like the business is just stretching itself just a little bit too thin relative to their average free cash flows. And keep in mind that their free cash flows have been pretty lumpy over this time frame. Even before the COVID-19 pandemic lockdowns, their free cash flows have been somewhat sporadic in those years. The COVID-19 pandemic had a major impact on the business, and while the company did pay down some of their debt in the next year, they subsequently have taken on even more debt, and their free cash flows have been declining over this time frame. Over their last 12 months, Starbucks has only produced $2.2 billion worth of free cash flow. That's down significantly from where they were at on average over these years. So again, it just looks like the business is utilizing too much debt relative to the cash that they're employing. It's worth noting that $7.6 billion of this debt position does come from their capital leases. Given the nature of both Starbucks' business and their strong brand power, their high debt load may not be as much of a potential concern here as it would be for some other types of businesses. But again, if this is something that you're potentially interested or concerned about, you can dig into the company's filings to learn more. They'll provide a breakout of all of this debt, which will allow you to dig into the details and understand when it matures, how it's structured, and what rates is the debt at. Again, though, this is an X on metric number 5, and so far through our first 5 metrics, we only have 1 check and 4 X's for Starbucks. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a reasonable starting point for evaluation of the business and potentially offer us a slight risk premium to the yield of the 10-year treasury. Currently, Starbucks has a $143.5 billion total enterprise value, and we're utilizing their enterprise value because it's going to give us a perspective of the business that's more similar to as if Starbucks were a private company by taking into account both their market cap and their net debt position. Over the last 5 years, we learned that Starbucks has produced $20.4 billion worth of free cash flow, meaning that in an average year over this time frame, the business produces about $4.1 billion worth of free cash flow. So when we divide their $4.1 billion of their average free cash flow by their $143.5 billion total enterprise value, that only gives us about a 2.9% average free cash flow to enterprise value yield for the business. So that's coming in below the yield of the 10-year treasury, and that's below that 5% risk premium we're seeking here. So on an average basis of their free cash flows, this is an X here on metric number 6. Also with their last 12 months of free cash flow being down from where they were at historically. To get a current free cash flow to enterprise value yield for the business, when we divide their $2.2 billion of their last 12 months of free cash flow by their $143.5 billion total enterprise value, that only gives us about a 1.5% current free cash flow to enterprise value yield for Starbucks. So that's less than half of the yield of the 10-year treasury, and again, this is well below that 5% benchmark. So this is an X here on metric number 6. Just because this is the case here doesn't mean that you're going to necessarily throw the business out in its entirety. It just means that Starbucks may not be as potentially attractive as some other types of businesses right now, and it's potentially less likely that the market is significantly mispricing the business in investors' favor. Then as a bonus, here we're taking a look at Starbucks' dividend profile. So currently Starbucks pays out a 1.9% dividend yield, and they've increased their dividend payouts in all 5 of these years. While the company has supported their dividends in 4 of these 5 years, as they took on significant amounts of debt in 2020, it likely would have been a more prudent capital allocation decision to cut their dividend and instead really focus on the financial strength and health of the business. While they subsequently have been able to support their dividend payouts with their free cash flows, things were pretty tight in 2022 and they've been even tighter over their last 12 months. So it does look like the business's dividend payouts, if they're not able to rebound their free cash flows to where they have been at historically, may be in some potential danger of being cut here. As again, it does look like Starbucks is employing quite a bit of leverage in their business already. So if their abilities to return capital to shareholders through dividends is something that's potentially attractive to you, part of the reason that you're looking at Starbucks, this may just be something that you'd want to pay special attention to and dig into more closely. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Starbucks, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Starbucks. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with an average of Starbucks free cash flows over the last 5 years. Then we're using historical growth assumptions based off how the business has grown their free cash flows over the last 30 years to project these out into the future. So it's up to you to do your own homework here to determine whether or not these historical growth assumptions are going to be potentially accurate and applicable going forward to give us a baseline projected estimate for Starbucks. But if we assume that the business grows their average free cash flows at a rate of 7.5% annually for the next 10 years, then we assume a terminal stage for the 10 years out after that, where these free cash flows grow at a rate of 4% annually. We're not going to be adding in the company's tangible book value just because this is significantly skewed based off how the accounting is done for their significant share buybacks over the last 5 years. So as a fair warning, that will have a significant impact on our DCF model. So that's an adjustment that you would want to make to this model for yourself after researching the business. If we were ideally seeking a 15% rate of return from Starbucks, however, which is the rate of return that Warren Buffett is ideally looking for from his investments, then again, with that caveat about their tangible book value, it looks like from today's valuations, a reasonable starting point for a value of Starbucks is only around $26 per share. So that is significantly below their current stock price, down by about $80 here. But again, please be mindful of the caveats here. Again, given how Starbucks has been both leveraging itself and returning capital to shareholders over the last 5 years, in addition to some of their transitions in management, it's really important that you dig in and learn more about the business. This ultimately is just a starting point and it's subject to change. The inputs here are likely to be better through deeper research into Starbucks. Please also note that this 15% rate of return would be including their dividends, so we would not be doubly counting their dividend yield of 1.9%. And be aware that a discounted cash flow model is based off the predictability of a business's future free cash flows. Given the nature of Starbucks' business, they likely have a somewhat moderately predictable business, even if their free cash flows have been lumpy over recent years, and the business is still involved in significant expansion internationally. So please be aware of the fact that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our summary for Starbucks, but we have to address something first. What are some of the qualitative aspects about this business? So starting with some of the key points around a potential long thesis for Starbucks. Number one, strength in the cold beverage platform could drive volume toward under-penetrated afternoon day parts, helping prop up average unit volume with minimal incremental labor costs. Number two, leading market share in China and exposure to a growing middle class contribute to a compelling growth narrative in that market. And number three, Starbucks Connect initiative should drive continued adoption of the firm's loyalty program, materially increasing customer lifetime value and helping drive new user acquisition. Then for some of the key points around a potential short thesis for Starbucks. Number one, shrinking Arabica growing regions could drive structurally higher green coffee prices, threatening gross margins if that price is taken in by Starbucks, or driving consumer switching toward cheaper caffeinated alternatives. Number two, food and energy inflation could pressure consumer balance sheets, dragging on near-term sales volume. And number three, intense competition for suburban drive-through sites could pinch margins, with domestic new unit openings skewing heavily toward those footprints. So hopefully that offers a potentially balanced perspective around some of the key qualitative aspects about Starbucks. Now it's time for a wrap-up. So in summary, Starbucks only checks the box on 1 out of our 6 metrics today. While the business does earn very high average returns on capital of nearly 35% in a given year, and their revenues have grown over the last 5 years, their earnings are down as they're paying more in interest expense, and their free cash flows are down because of big changes in their inventory and a change in their other net operating assets. A bright spot, though, is that the company has bought back 17% of their shares outstanding over the last 5 years. So this has significantly increased existing owners' share in a pretty wonderful business that has a lot of qualitative aspects working in Starbucks' favor. One big downside is that the business has leveraged itself pretty heavily over the last several years, and this had not necessarily been the case for the business prior to this. While more than $7 billion of their net debt position is from their capital leases, it still looks like the business would not be able to support its debt load with their current free cash flows or their free cash flows over the last 5 years. Again, this may or may not be a potential concern for you, especially given the nature of Starbucks business. Also, on a current and an average basis, their free cash flows to their enterprise value yield, when we compared that to the yield of the 10-year treasury, it did not look like that was giving us a potentially attractive risk premium in comparison to that treasury yield. And then Starbucks has continually raised their dividend payouts, even as their free cash flows have declined and been somewhat lumpy over these last 5 years. So if the business is not able to increase its free cash flows going forward, it looks like their dividend could come under some pressure. Finally, performing a discounted cash flow analysis of Starbucks. If you've done the work and you believe that those historical growth assumptions are going to be accurate and applicable going forward for the business, then if you were seeking a 15% rate of return for Starbucks from today's valuations, it looks like a fair value for the business is only around $26.50 per share. So again, that's significantly below what their current stock price is, down by $80. However, that's just a baseline estimate, and there are reasons why that may not be potentially accurate for the business going forward. We touched on a major one, which was how the accounting is done for their share buybacks. Another one is given the overall disruption that the COVID-19 pandemic had on the business, and how that really slashed their free cash flows in 2020. Since then, the business has rebounded somewhat, but they're still not at the free cash flow level that they were at prior to that. Again, it's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Starbucks. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand the ins and outs of that company and understand what's important and what's not important going forward for the business, learning accurately, completely, and then going back and asking yourself, what did you miss, in order to understand the underlying essence of Starbucks. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Starbucks business, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for Starbucks will be. So with that said, that's it for today's fundamental stock analysis of Starbucks Corporation, ticker symbol SBUX, SBUX. Again, we made a revised analysis of the business today as a very popular subscriber request, so I'm happy to make an updated video on Starbucks. And if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Starbucks with me, and have a great day.